Welcome to a lecture on taxation of business income. This lecture is based on the provisions of Income Tax Act of Kenya, Cap 470. And I will basically cover the following two areas. Introduction of business according to Income Tax Act, including the forms of business, and introduction to business income and business expenses according to the Act. Let me begin with definition of the term business. A business is any profession, trade, or vocation, and every manufacture, adventure, and concern in nature of trade, but does not include employment. This is because employment is treated as a separate source of income under the Act. From the definition above, I would like to explain a few terms which are being used. And first of all is the term trade. Trade is any business in nature of buying and selling of goods or services for profit purposes. Then the term profession. Profession is a professional practice done by a person after qualifying and having been licensed to practice professionally. For example, we have accounting profession or accounting, professional practice in accounting, a professional practice in engineering, professional practice in medicine. Therefore, those people who are licensed to practice as an accountant, as an engineer, and so on, they are in business, and such activities are therefore subject to taxation depending on the provisions of the Income Tax Act. The next term is vocation. Vocation involves using one's life in earning a living on talent, which may be either inborn talent or talent acquired through practice. Finally, the term adventure. This is an organized trade which is usually unlicensed also, but must be a trading adventure. To explain this further is that you may get involved in a trading activity, but without intention to trade. But due to the fact that the activity which you are involved in is a trading activity, it is therefore classified as a business. From the definition, we also got to interact with the term nature of trade. I would like to elaborate on this term also by looking at the factors to consider in ascertaining whether a business in nature of trade has been conducted. And these are the factors that are considered. The first factor is a profit motive. There must be a profit motive or a motive to make profit for an activity to be considered trade. In this case, the profit motive must be the overriding motive and should not just be incidental. What I mean here is that if an individual, for example, travel and on their journey they find a nice dress which they think a friend may like and purchases the dress and hand it over to a friend at a profit, that may not be considered trade because the overriding intention may not be the profit motive. Then number of transactions. In a situation where a series of transactions is involved, this is usually an indication of trade. However, it is possible that even a single isolated transaction may constitute trade if the other factors which we have looked at and we are continuing to look at going forward are overriding. then in that case, the nature of the number of transactions may be disregarded in determining whether a business in nature of trade has been conducted. Method of financing of the assets is also one of the factors. For example, where the proceeds from sale of goods are used to acquire more goods, this indicates that the goods are in a trading cycle or in a trade cycle. That is to mean that goods are continuously being acquired, and once goods have been sold, the proceeds from there are used to acquire some more goods which are then sold. This may indicate trade. Next is the method used to generate sales. And here we are majorly talking about sales promotion. In a situation where sales promotion takes place, this suggests that a business is in existence in nature of trade. Then the nature and method and mode of acquisition of an asset is also very important. In a situation where goods are purchased for resale, a trade may be assumed to be taking place. However, if goods which are a gift, inherited, or acquired for private use are sold, it may not constitute trade as such, but may constitute disposal of assets. Finally, we are looking at the length of time an asset is held and how it is used. If an asset is acquired and used for some time before it is disposed, then the sale of such asset may not constitute trade, but may be realization of a capital asset. But in a situation whereby an asset has been acquired and before it is used, it is sold, then it may be an indication of trade. I would then like to explain something on the forms of business. And talking about the forms of business, I would introduce it briefly to say that there are three forms of business as below. First is sole proprietorship business. Secondly is partnership business. And legal person or limited liability company. However, these forms of business are largely grouped into two by the Act, whereby the Act consider the first category to be a category which includes sole proprietorship and partnership. These forms of business ownership or forms of business have no separate legal personality from the owner. This is to mean that the income from the business is income of the owner. Any profit made by sole proprietorship business or partnership either belong to a sole proprietor or to a partner, respectively. Therefore, it is the owner who is supposed to pay tax on such income. These types of business give rise to only one taxpayer, who is the owner of the business. The second category is the category which is legal person or corporation. These are limited liability companies. Limited liability companies have a separate existence apart from its owner. The owner of a limited liability is a shareholder. So a limited liability company has a separate personality from the shareholder. Therefore, this form of business gives rise to two separate taxpayers. That is the business itself and the shareholder. The income of the business is divided between the shareholder and the business itself, and both pay taxes on the income. The owner pays taxes on their own income from the business, which are in the form of dividends, and the business also pays taxes on its own name, which is known as corporation tax, which is part of the income tax. Finally, I would like to introduce business income tax, which involves looking at two components of business income tax. The first component is business income, and the second component is business expenses. Starting with business income is that business incomes are divided into two categories also, whereby the first category is taxable business incomes and non-taxable business incomes, otherwise known as exempt incomes. Taxable business incomes are those incomes which are tax chargeable, and non-taxable business income are those incomes which are not tax chargeable. When we come to expenses, is that business expenses are also divided into two categories. The first category are allowable business expenses. These are also known as deductible expenses. Then we have disallowable business expenses, which are non-deductible business expenses. The very simple definition of allowable business expenses are that they are deducted from income before determining the income tax of the business, and non-taxable or disallowable business expenses are those expenses which are not deducted, which are not supposed to be deducted according to the Act from business incomes before determining the business income tax. That is the end of the brief lecture on taxation of business income. Please look at the next lecture, which has detailed explanation on taxable and non-taxable business incomes and allowable and disallowable business expenses.